Frickin' Neil Kashkari was a bastard today. All right, screen is looking good. Everything's good. Wow, very smooth start. 102 and we're off going already. All right, so the problem today was, is, whatever you want to call it. See, was and is, also arbitrary. I know I highlighted it somewhere. Wait, it must have been, it was before we talked about the oil. Oh, I see, this is in proper order. Oh, I didn't actually pull the article. How lazy of me. Okay, anyway, so Kashkari's the one that said something. I meant to, I just didn't. News. Latest news. Good idea to take a look at what's going on anyway. Piedmont Lithium. Okay. Hey, that's a good point. Okay, let's look at how I read the news. So, Piedmont Lithium. I read the headline and I'm like, okay, don't care about Piedmont Lithium, but money is coming in. That's what registers in my head. I'm like, oh, look, DOE money coming in for lithium companies. That's obviously a positive for those guys. Industrial movers, nobody I care about except for Generac. Horrible. Look at Generac getting killed. Adobe has conservative guidance. Colgate. Yeah, Third Point's agitating over there, but we don't care about Colgate, really, not one of my favorites. And when I say we, I mean me, but we don't follow it, so what's the difference? All right, Netflix 14% up. Holy shit. Well, people are really happy with that turnaround. Do we have Netflix? I don't remember if we have it or not. I know I thought they hit the bottom, but I don't know if we actually committed to it. Parkland plunges. Don't really care, but you got to think about why Parkland. They're a distributor of fuel, so just get caught in the middle sometimes. And you don't have the right pricing model. Then when inflation can really whip you around. We talked about that already. I'm not going to get back into it. Carvana. What happened to Carvana? 16%. These guys, all of it. Wow, Winnebago got killed. Ew, wow. Ooh, that's not going to be good for Thor, I don't think. See, how's Thor doing? So, THO. Yeah, they're down 10% too. Because, everybody's going to assume if Winnebago's got problems, then Thor's got problems. And they do have problems. They have huge supply problems. They have a huge amount of inventory sitting on the lot, like 70, 80%, 90% completed. Can't sell a 90% completed unit. But think about how many parts go into an RV. It's not just a car. It is a car. It's a whole car. And then you need the cabinets and the sink and the pipings and the bathroom and blah blah blah. It's a house and a car. So a huge amount of parts that have to go into it. So that's got to be a mess to them. I'm sure, from a financial standpoint, I'm sure they sourced a huge portion of it overseas. So until the supply chain issues work out, they are going to be hit. But no reason to let go of it, because it will eventually work itself out, and no reason to not buy more of it, frankly, when it gets cheaper. Who the hell? What is that? Mullen Automotive. What did they do? Okay, fine. Low earnings, Lowe's falls on a downgrade, Snap rises. That's interesting. I don't see why Snap would suddenly be doing good. Upbeat comment from Citibank, social media catalyst watch potential for upside revenue, neutral rating overall. Okay. Abbott falls 8%. Why? What did they do wrong? Citing a 5% drop in sales, COVID-19. Oh, their COVID-19 tests. Aha. Okay, so what can you do? Obviously, they're not going to sell as many tests. Although COVID is raging back in parts of the world, Fauci is very concerned about the new strains that are out there. So we will see. Apparently, though, Moderna and Pfizer are still the good shots. Do not accept anything else, because these Johnson & Johnson shots and things like that do not help you at all when for the new strains. The new strains are so bad, though. It's like, even if you have shots, you're almost certainly going to get COVID, but a mild case. So it's basically the best you can hope for is to escape with a mild case. My mother's friend, been down here for 3 years, didn't catch COVID. You know, she's probably about 80, like my mom. So she's about 80 years old. Didn't get COVID, no problem. She goes to New York on Friday, and today she's got COVID. So either she got it on the plane or she got it up there. I think like it's a different strain up there. I think that they probably don't have exactly the same strain, so maybe you're resistant to something here that you're not there. And the sudden change, not to mention suddenly going into the colder weather for these Florida people, man, they can't take it. They don't like it they don't like to walk in the frozen food aisle of the grocery store. They freak out. You tell them it's below 60 and they're like grabbing their fur coats. But we shall see. I'll be up north this week, actually, so we'll see if I get sick. Hopefully not. In fact, because I'm going up north, I just got my flu shot. So next week, by the way, no webinar, because I'll be up north. Oh, look at that. More lithium money going in. See, that's what I mean. When you see one, they're going to be, you can imagine it's not going to be one guy who gets a grant. So that means they're handing out grants, and any lithium company you want to invest in is probably going to get some money. Oh, here we go. PLL is getting 140 million. TLOF. Now, see, this is funny because if they're getting 100 million out, AOB gets 150 million, but so do companies 1/10 their size. So that's not really fair. And don't forget, grant means you don't pay it back. That's just free money. Oh, Mullen, what did you guys do? Electric last mile acquisition. Mullen shares completing a purchase of electric last mile. So what, they bought a bankrupt company? Are you kidding me? Capable of producing 50,000 autos. Oh, I see. So it's like they think they're like Tesla, because that's what Tesla did. They acquired an old GM plant to get started. They own all the FP. Okay, I mean, honestly, it's a good move for them. It's the right way to go about it. Wow, that's incredible, though. It's like huge jump into it. HSBC. Yeah, good luck with that. Contrarian plays bullish on treasuries while playing a risk bounce. I'm not bullish on treasuries. How can you be bullish on treasuries when clearly the Fed is not tightened enough yet? You have to see inflation slowing down, and it's 10.9% in Europe this week. So this quarter, so 10.9% is not slowing down. They're behind us in tightening, but still, it looks like we're quite a ways away. And again, I hate to I get confused with the webinars. I don't remember if I said something or not, but I know 6%. Anyway, 6% in June is my prediction for when the Fed is done. I think what's going to happen is when at the point at which the Fed funds rate and inflation cross. So in other words, inflation will be coming down from 10% towards 6%, and the Fed funds will keep rising until they get across. So my theory is we should get across in June. And at that point, the Fed should stop. If they don't stop, they are over tightening because they're not taking other factors into account, like the diminishing stimulus in the economy, as well as the global slowdown. Of course, it's going to impact a lot of things. So you can't, you can't just look at U.S. data points, and that's one of the problems with all U.S. policy is we all look at our own data points. And how do you look at your own data points when 60% of the S&P 500's revenues comes from overseas? How does it make sense to look at your own economy's data points when every other economy affects you? That makes no sense. You have to have a broader perspective. Now, you say that though, and they're like, "Oh, well, that would be a real pain in the ass." And so we'd have to go in, we'd have to go gather data from like all these different countries and stuff. Like, yeah, that's what you should do. You're doing a half-assed job, and you're saying you don't want to, you feel that's good enough. It's not good enough. That's why all these economists are off by 100%, 300%, because they can't predict for shit. Because they're not taking enough data into account. And they say, and then if you ask them, if you ask what I call the economorons, if you ask these analysts who make these predictions, they say, well, I looked at all the Fed's data and they said this and they said that. I'm like, but where did the Fed look at? They didn't even poke their nose out of the country. You get maybe one line when they do the beige book, there might be one line talking about overseas. Or they'll talk about imports and exports like as if that's all you care about for overseas. That's not the way it works. McDonald's doesn't import and export. McDonald's sells hamburgers overseas. KFC sells chicken overseas. Their revenues get recognized in the US, but not if they don't make it. Right? They got to make the money and send it here from overseas. So it's not import export, it's cash getting transferred. So it's, so we're there's so much stuff that's not being taken into account. Oh, hey, what did I just say? Moderna, Pfizer. Moderna and Pfizer are the way to go. Don't take any substitutions. All right, soaring yields offset strong earnings. What does that look like? And we all know this, though. Again, this is not a surprise. Oh, look at the bonds. People keep saying it's time to buy bonds. I'm like, how could you be that insane? We're at, I don't even know anymore. Are we at 3.25%? I don't even know what the hell the Fed funds rate is. I have lost track. I think it's 3.25. What is the Fed funds rate? See, now if Google worked properly, it should be a big number right in my face, right? Yeah, 3.25. Okay, so I just don't want to say anything wrong. I like to check, even though I think I'm right. So what did I say? I forgot what I was talking about. There, bonds. Right. So we're at 3.25%. And here has been the effect of going from 0.25% to 3.25%. It's been basically a, what do we want to call that? That's 22 to 10 is 12 out of 22. I don't want to guess that number. It's 15%. No. 12 divided by 122. That's 10%, dummy. Really? Really? I couldn't figure that out without a calculator. I don't know what I was thinking. It's sad. That pisses me. I do to myself what I used to do to my kids, right? Like my kids would like exactly that. My kids would be like, "Oh, I gotta get a calculator." I'm like, "Really? You need a calculator for that?" Now I'm getting a calculator for stupid shit. Oh, that's where my head was. Oh, here you go. The 30-year, 145 to 121. That's 15%. That's the one I was thinking of. But there was what was going on in the back of my brain. I was going to say these are down 15, 20%. And I'm like, no, that's not 15 or 20%. And I couldn't think of anything other than that. So anyway, 45 to 21 is 24, I'm going to guess. And frankly, that is 20. Well, it's 20% of that, but it's not 20% of the higher number. 145, 16%. Yeah, there you go. All right, so a 3% increase in the Fed funds rate has caused a 16% drop in the 30-year bond. But clearly 4.5% is already priced in. So these numbers are also forward-looking, right? So I think the more accurate one, the 2% tells you what the funds rate is now, or more immediately, and that's gone down very little. That goes down effectively with the Fed funds rate, right? So you have a 3% drop in the Fed funds rate, you have a 3% drop in the 2-year note, because they go by effectively whatever the Fed funds rate actually is. The 5 years, you're speculating out for 5 years in advance, but the 30 years speculating out 30 years in advance. So the 30 years is seeing quite a bit of inflation for a very long time. That's what you're being told here. And the 10-year less so, and the 5-year, it was like 6-7% here. So we got 6% here, 10% here, 16% here. That's basically how it's going, of a drop. Now, in either case, though, you're really only pricing in here 4.5%. Here you might be pricing a little bit more than 4.5%. because of the speculation, but the speculation here is probably 4.5, a little bit more than 4.5. So as the Fed goes past 4.5, we're going to get another big drop in treasuries. And then the trick will be, if you want to go positive on treasuries, then you want to basically pick the point at which the Fed is going to make the turn. And like I said, that's going to be the point where the inflation rate crosses below the Fed funds rate. That's when they're going to stop. And that is going to be June of next year, according to my calculations. So we'll see if I'm right. We only have to wait 9 months. I like more immediate satisfaction than that, right? I should be see, somehow I was like, that's the fun thing about day trading, is you get to be right or wrong right away. But to me, day trading, because it doesn't, it's a sentiment trade, and I don't like a sentiment trade. I'd rather trade fundamentals. And even worse, it's a technical trade. That really ticks me off. We were looking at futures. Oh yeah, we're in the futures. So how are things going? 36.80, gotta hold 36.80. 11,000, gotta hold 11,000. This is not good though. We're back to our thing. 1750, had to hold 1750 and didn't. And 30,000, of course, has to hold too. So everything is being threatened now. We went from really nice to like everything is now back under siege, and we're back to where we were here. Look where we are, and even in October, the Russell was the lowest, right? So we're back to where we were at the end of September, which was not a particularly good place, but we did get saved at the end of September. So, whether it was window dressing or whether it was deserved, we'll see. But again, I remember we were looking at the news. See, why doesn't anybody remind me of what we were doing? Oh, I see. We got distracted by the yields. Offset, and again, strong earnings. Oh, I just had that number too. See how easily distracted I am? I don't know. I mean, on the one hand, it's like I feel like I'm being distracted. On the other hand, I feel like it's the color commentary. It's like I'm, who was that? Oh, Phil Rizzuto. Yeah, I'm Phil Rizzuto. Phil Rizzuto on the markets. I come up with a story. You're trying to pay attention to the game, and I'm like, oh no, that was like the time we did this and that. But he was great. He made the game so interesting. It was so much fun. Anyway, so get on a Phil Rizzuto rant now. 62 companies as of this morning reported. 76% of them beat. We're up 3% overall. Q4 guidance is up 5%. Q4 guidance better than what Q3 is coming in at. Where's the freaking recession? All right, but then, and now we can get back on track. It's exciting. Hey, I got us back on track. Home Depot preferred to loans. I kind of agree with that. Interactive brokers. Somebody gave them a lot of money. Mineral Technologies, Fox, don't care. Energy stocks rally as oil prices are poised for the first gain in 4 seasons. As I said, they're all going to be making a shitload of money, so that's not too. That's pretty obvious. Oh, did we talk about that? I was going to talk about that today. I think I forgot. Home sales listings slumped the most in the crisis, COVID crisis report shows. Okay, that's fine. Home sales and listings are slumping. Why? Because mortgage rates are now over 6%. So there's two problems at the same time. The buyers are sticker shocked because you don't buy a home, you buy a state all the time. You don't buy a home, you buy a mortgage. You buy an obligation to make a payment. And so if you are being squeezed, like your salary is being squeezed because your raises aren't keeping up with inflation, you have less money to spend per month. And at the same time, the price of the home per month has gone up shockingly, almost 50% in some cases. Because we were getting 2 and 3% loans, and now we're getting 6% loans. That's a massive difference. Not only that, though, but taxes are going up too. And nobody even talks about property taxes. Property taxes are horrific in parts of the country. So the home buyers don't want to spend all that money on a mortgage. That's a function of the price of the house plus the mortgage interest. And the home sellers, now think about this. I'm sitting in a house and, I've got a 500, well, here you go. Let's work it out. I don't have a particularly favorite. Oh, well, lending tree is pretty good. Oh, bang rate. I'm going to I see. All right, that looks simple enough. Okay, so I'm in a house and I've got a $500,000 house. I got a $400,000 loan and I'm paying 3%. So my payment is $1,686 a month for the house that I have now. Let's write that down. 1,686 for $400,000 mortgage. So that's you and your house for $400,000, right? You can sell your house for $600,000. That's freaking great, right? You're going to make $200,000 on the sale. But to buy a house similar to yours, you're going to have to spend $600,000. So it's not really helping you. You're still going to have a $400,000 mortgage, but this $400,000 mortgage is going to be 6%. So that's $23.98. That is $700 more, which is what, 40%? Whoop, oh, that's my calculator. I'm like going for my calculator. All right, so 700 divided by 1,686 it was, 40%, okay. So you're paying 40, your mortgage jumps 40%. Also, the cost of moving is shocking. The cost of furniture is shocking. The cost of everything is shocking. So houses are coming off the market. That's what's happening. It's too expensive to move, and people don't want to sell their houses. So the listings slump, the buyers dry up. All right, but you know what's interesting? The home builders were up. So housing permits were up and significantly. We'll get to that hopefully soon. And that was very surprising. Well, it's not surprising because it shows that the builders have confidence that they can build homes people want to buy. But you see what happens though? So the person who's in the house and has the cheap mortgage doesn't want to go. Why would you trade in your 3% mortgage? Why would you trade in your 3% mortgage for a 6% mortgage? How badly could you possibly want the house? You're paying, for every dollar you borrow, you're paying 40% more every single month. And you're locking that in for 30 years. Oh my God, do not get an arm. You have no idea, because if anything goes badly and whatever, and the Fed ends up with 10% rates, you'd be so screwed. Oh, that's another thing. Aha. 5-year adjustable rate mortgages usually reset every 5 years. So for a lot of people in the last 3 months, their adjustable rate mortgages have kicked up. People who had a 2%, 3% adjustable rate mortgage from 5 years ago are now flipping that mortgage. So even sitting in your own house, if you have an adjustable rate mortgage, you didn't refinance it, which sadly people don't think to do, and your bank sure as shit doesn't tell you to do it, which is stupid, because if they told people to do it, they wouldn't have their underwater homeowners like they do. But they don't. But they're like, oh well, we'll get more interest out of them. That's going to be great. And I'm sure they run the numbers, and I'm sure it works for them. But what do? They cause perfectly happy borrowers to be underwater, because all of a sudden they have a 40% bump in their mortgage rates that they can't afford. But the banks never warn you. Not your own bank. Other banks tell you to switch banks, but your bank doesn't warn you. And then so many people have spam blockers and things like that. You're actually blocking the one useful thing that people may be trying to tell you. It's like, hey, don't have an adjustable rate mortgage. So, number of homes sold dropped 25% in September. Oof. New listings down 22%. That is the worst since the crash. Many Americans staying put because they already relocated and scored a rock bottom mortgage during the pandemic. They have little incentive to move. Housing payments are at a 2-decade high. Also, that's another thing. Nobody has to go find a job elsewhere, right? There's so many jobs that most people can find a job wherever they are. They don't need to sell their house and go somewhere else. And with monthly payments amid a 2-decade high, mortgage rates causing homebuyers to stay put. I just said that. Deals are increasingly drying up while the buyer competition is falling. So what's that going to cause? It's going to cause a housing crash. 60,000 deals were canceled in September. 17% of the homes, almost 20% of the homes under contract failed. Again, the highest percentage on record, with the exception of the pandemic. I used to be in the title business, which is like the mortgage business and title insurance. And I know, like looking at these stunning numbers, like holy shit. The housing market's going to get worse before it gets better. Inflation is rampant. The Fed is going to keep hiking rates, which is going to make these numbers forget that. Look at this. Look at what 9% does. That's double. You get up to a 9% mortgage, that is double what it was when it was 16 something before. So the same mortgage, double in payments. That throws a lot of people out of the market. And that's without taxes or anything else. No insurance, no anything. That's just your basic mortgage rate. That's just without any other calculation thrown in. It's a complete disaster. Who can afford that? How many families, how many families can afford an extra $1,600 a month, an extra $20,000 a year, basically? So what has to happen, right? So if the rates don't come down and the people can't afford the houses, then the housing prices have to come down. Otherwise, there'll be no movement in the housing market. And if there's no movement, and by the way, if there's no movement in the housing market, what does that mean? It means all these millions of people who claim to be realtors. I'm sorry, they are realtors. They claim to have jobs because they're a realtor. And then you say to them, have you sold any houses? And they're like, well, no, but I'm a realtor. And that goes for mortgage brokers too. There's God, there must be hundreds of thousands of these people running around. It's like a pyramid scheme almost. Because all the broker cares about is that you get listings. Once you get a listing into the broker, they're going to get paid. That's all they care about. They'll hire 1,000 people because they don't pay them. It's like Uber. We're not going to pay you, but if you can get someone to get in your car, then we'll take half the money. That's basically how mortgage brokers work. Not mortgage brokers, realtors. Well, the mortgage broker works that way too. He gets a guy to write a mortgage, and he gets all the money in the mortgage, and the guy writing the mortgage gets a tiny percent. Anywho, so bad stuff. So that's not good for Now they think it's bad for builders, but it's not really bad for builders because the builders will switch to building low-cost housing, and they'll make maybe less money, but they'll be okay. They're not going to be dead, because the existing housing is not suiting the current environment. And I'll tell you what's going to be the new thing, which is an old thing, is that a lot of homes are going to be built with mother-in-law suites or whatever you want to call them, like separate parts of the house, possibly with their own kitchens, where you can, to reduce the pain of having to bring a parent in, because this nursing home thing, holy shit. That same friend, the one who caught COVID who went to New York, she's going to a place that costs $6,000 a month. It's a nursing home. That's where she's going. She's going to a nursing home. It costs $6,000 a month. And it's not even that great. It just blows my mind. I'm like, you look at people, there's some people who live on cruise ships, and it's probably cheaper. It's cheaper. I'm sure it's cheaper, actually. It's definitely cheaper to live on a cruise ship than it is to go into a nursing home. So where was I? The overall slump in home building demand, blah, 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 blah. Anyway, so you have to watch, but of course they have to adjust, and it depends on how sensitive they've been to the market and so on and so forth. Like I said, I like Covenantian because they pay attention to this crap. I don't know how well they're doing now, but we don't have them, but I like them. Because again, you can't just buy everything. It's tempting though it may be sometimes. Chart. Oh, there we go. We got a chart somewhere. HOV. Yeah, they're down nicely. And then Toll is always a good one. I think we have KBH somewhere. I really thought we had some builder, or DHI, maybe DHI. They're all down about the same though. They're all getting treated the same. Then we got CIM, the mortgage REITs. Now, you got a case with the mortgage REITs because there's going to be less mortgage activity, but not no mortgage activity. There's still plenty of paper to write. So again, they're not losing money doing their business, so therefore they'll get through the recession and eventually start making money. So I don't see the point of that. I don't think that's I think these are very stupidly underpriced right now. See if you have any questions. No questions. All right, good. See, this is why I ramble, because you guys don't ask any questions. Of course, if you ask questions, it just distracts me further. So, oh well, can't win, I guess. Where were we? News. Yes. Okay, there you go. So what else happens? Norvax. Nope. Plug Power drops plans for 2 plants, cuts hydro. Oh, really? Plug. Bad. Snap gains 5%. Yep, people like Snap for whatever reason today. Spurgeon Index, FNB stocks. Thor. Oh, look, we have Thor. Whoa. Oh, that's not okay. So I'm sorry, they're mentioning Thor. Thor and RV stocks drop after Winnebago warning based on the following trend. Winnebago, blah, blah, blah. So Pier goes, so if Thor goes down because Winnebago went down. So Polaris downgraded, blah, blah, blah. Okay, stupid. It's always a good time to improve your position because they just went down because the other guy went down. Biden, EV battery manufacturing, great, thank you. Malaysia's doing some stuff. COVID-19 remains a global health emergency. This is important. Even though the number of deaths weekly is the lowest since the pandemic was declared, that's not true. There's no way that is a true statement. Global health emergency made on January 30th, 2020. Okay, I'm not going to get into the weeds on that. I guarantee you this is not true. Even though cases are declining, the agency said many countries still need to get the most vulnerable populations vaccinated. The public perception is the pandemic is over. It remains a health event. That's a big problem because people are not getting their shots, is the new strain shots. Moderna reported its updated Buddha COVID booster produced better antibody response compared to its original spike vax. Okay, great. We know that. Precision drilling. Okay, they're a good little company, actually. Amazon offering home insurance. Look at these sons of bitches. Home insurance. Wow. Okay, that's interesting. Somebody else was, oh, who else was doing something I thought was really cool? Oh, McDonald's. Well, not McDonald's. It's good for Krispy Kreme. McDonald's is going to start selling Krispy Kreme. How are they doing? Should be way up. I don't think people understand the concept of like how much McDonald's can boost something. Oh, they're not public anymore? Oh, that's not fair. The good stuff happens when they go private, right? Ooh, ISRG, love them. 12%. Damn. Did we ever buy them? I know I wanted to. Ugh, I'm gonna cry. That's one I really did want. Can't imagine why I would not have bought them. Bastards. Do not tell me we didn't at least sell some puts on that. That's annoying. All right. Well, if we didn't, we didn't. But I thought we did. Nokia. we were just reviewing some companies. We're like, really? They're still in business? Like, I don't know anybody who has a Nokia phone. I don't. I was just like, I do not see them around at all. But they have other businesses. They are very big with like laying cables and things like that. See, building 5G, building epic 5G networks, not just 5Gs, epic 5Gs. I love that. It's a Gordon Ramsay thing, right? Especially the Europeans. They love to like give adjectives, superlatives, whatever you call it. Choppy trading, blah de blah. Sunco. Where the hell are we going to get to the report? Gilead said to fight Ebola. Gilead sent to fight Ebola in Africa. That works? No. See, there's no proven vaccines or treatment. So, yeah, San Diego, get Moderna on this thing. Really, just give Moderna money. I mean, for God's sakes. Well, they got money. It's just not worth it, because there's not enough cases. Preclinical remedy using non-human primate indicated treatment in combination have led to survival rate of 80%. Wow, well, that's not bad. Compared to 20% of single agents. Oh, how horrible. Oh, that's what we were looking for, Kashkari. What did you say, you bastard? Oh, speaking of 1 p.m., so he's tanking the market now. He's the one that caused the additional downturn. You son of a bitch. So what did he say? So before he's speaking, he said something? Fed president said Tuesday there will be, he said Tuesday. This is not Tuesday. But anyway, so he said that yesterday, and now they expect him today to say the same thing again and reiterate it. But meanwhile, okay, it's the same thing he just said. See, Fed may need to raise rates past 4%. Yes, they're raising it to 6%. Thank you very much. Why don't you just ask me in the first place, and I could tell you. See, that's bad. Oil, a slight draw in oil versus massive builds last week. That's no good, though. You can't have a 10, 12, minus 5, 7. You have a 7 million barrel build here and only a not even 2 million barrel draw here. That's not evening up, right? You've got a net build of +5 for the month. So that's no good. But you see here, so far we haven't come across anything that would make me say, okay, things are worse than I thought. They're not. Paulo Schwab, we don't care. American Mobile, we don't really care, although honestly, that's another company. Well, AT&T is getting so shitted on, I'm not sure I want to play with a Mexican phone company. Petco's all-time low, downgraded. Boy, even dogs aren't getting along in the recession. United Airlines surges. Ooh, surges 6%. Oh, so therefore we have some more airlines coming up, and they're going to also probably get some good results in. That's surprising. It actually depends how well they hedge their fuel is the main concern. Senator Warren wants to block Kroger's and Albertsons. Oh, Lizzie. I love her so much too. You can't just knee-jerk block everything. Big chains like Kroger and Albertsons are already gouging families with inflated prices, more mergers and competition, blah, 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 blah. Oh, come on. They're barely making money. They make 2%. Antitrust. You know, I mean, I guess the point is they're making 2%, which is what a supermarket should make. They want to make 3 and 4%. That's interesting. I guess from her perspective, I mean, that's their evil scheme, is to get together and crowd out the competition and then be able to raise prices and make much more profit. That's what they tell their investors they're doing. And so where are they going to take this money from? They're going to take it from their customers. That's their goal. We're going to provide less and charge more. That's basically everybody's plan, you know. But it gets to the point where you're just kind of against capitalism, right? Look, also urging the FCC to block Amazon's acquisition of iRobot. and JetBlue's buying Spirit. They don't like that either. Oh my God. See, I would let the merger go through and then say, under no circumstances, you know, should you exceed these margins, something like that. But you know, again, inflation is a very push-pull, right? You hit a point where you have to raise prices, and you decide what prices you're gonna raise. You're not gonna raise your prices to get back to break even. That doesn't make any sense, right? So you raise your prices enough to make a profit. Sometimes you luck out and the price increase goes through and the wholesale prices drop and you end up making a better profit. That's your freaking job if you're running a company, though. You're supposed to do that. You're not supposed to guess wrong. You want to stay ahead of the curve. But it's always a back and forth and experiments, just like when we balance our portfolios, right? It's a back and a forth and a back and a forth, and you try to figure out where the good balance is. That's what you have to do. Real estate ETFs struggle on weak housing starts, 25-year low for mortgage applications. Well, what year is it? Now you got to do math again. Oh, it's back to 2000. No, it's not 2007. That's a 15-year low. So 1997. Yeah, 1997. Why was 1997 so low? We had a great market back then. Interesting. I guess everybody had a house by that time. Okay. This is very boring at this point. Lockheed Martin, yay! We love Lockheed Martin. Lockheed, that's stock of the century. Lockheed Martin 5-year bond sale to fund buybacks. Ooh, fun. Lockheed Martin offering investment-grade bonds, raised $3.5 billion, $4 billion. That's not much. It's offering 41 years, blah, blah, blah. Lockheed yesterday increased their share repurchase plan by $14 billion, doubling buybacks this year to $8 billion. That's still not much. Still, if you're going to hold the stock for a century and they buy back a couple of percent a year, that means they'll be private soon. Right? So you got to be patient when you're an investor. Got to have that long view. So when I'm 150, they will have bought back all the shares. Look, oh wow, look at this. How that look short term? Oh, that's so great. Yeah, we definitely own that. Okay. Jeez, that is nothing though. Well, you wait, you wait. This is my pick for the first quadrillion-dollar company. And you say that's crazy, but meanwhile, inflation is going to get you there pretty quick. I think they're still possibly a leader, probably top 5, for sure top 5, possibly in the lead, though it's hard to tell because it's so secretive. But in nuclear fusion, the people who crack it are going to just basically own the energy system. They're going to own massive, the whole continent's energy kind of thing. There's going to be 3-4 companies in the end that are going to be selling fusion, and it's going to be everywhere because it makes the most sense. So once they get it working, it's going to replace all the power companies, all the oil companies, etc., etc. And I hope it's soon because we're running out of time. We are running out of alternative time. Do you know we killed off 70% of all species in the last 50 years? That we've actually 70% of all the life on Earth has gone extinct. All the species, anyway, have gone extinct in the last 50 years. There's only 1/3 as many kinds of animals left in insects and whatever as there were when we were kids. It's really horrifying. Even more horrifying, we're not stopping. It's not slowing down. So eventually, well, here's the thing. Well, Lockheed Martin bought back all of their shares. 8 billion's not bad out of 114, right? It's about 6%. 6.5, 8 divided by 114, 7. Ooh, more than I thought. So they're buying back 7% of their stock per year, and they're financing part of it with bonds. And they've only got $9 billion in debt or $10 billion in debt, and they're dropping $6 billion to the bottom line, basically a little bit more. But so in other words, what I look at this as is they're a rock solid company now. Okay, we're getting into more of a war footing, which is great for them. They love it when we go into a war footing, and we're getting much more into a war footing with Russia and China and whoever the hell is annoying us at the moment. But we're certainly, saber rattling. And not only that, though, but Japan is remilitarizing, and they've got like basically no military at all, and they're building up their military because China's scaring the shit out of them, and Russia. They're real close to both of those guys, and they're in the middle of that Taiwan shit too. So and of course now other countries, all the NATO countries, everybody wants arms. It's absolutely a good time to be Lockheed Martin. But this is why we invested in them in the first place. And they're a stock of the decade, so it's been a while. Let's see if we can go all. Yeah. So as you can see, it's been a good decade so far, as they've gone from like 50 to 400. So we're real happy with them. We actually didn't pick them though. What happened is our original stock of the decade was iRobot, but then they sold their military robot division. So, well, I need this chart to do that. So IRBT, oops. And I was so pissed because they were our stock of the century originally. So, oh, you can't even see that far back. So anyway, so sometime, well, I'm sure, yeah, that's true. We picked it when PhilStockWorld started in 2006, 7, somewhere around there. So we started around here, and they were $15 in. They went up 10 times, and our goal was they would be a 10 bagger. So I said the most likely person to be a 10 bagger in the century was going to be iRobot, because I said these Roombas are incredible. And from that, they're going to be able to do other stuff. And now they have a mopping robot and a window cleaning robot and a pool cleaning robot. But also what I really like the most about them was, which is gone now, is their military robot division, because they have bomb sniffing robots and all sorts of other useful battlefield things. They sold that division because they felt that the consumers might object to their killer robots. It might make the consumers uncomfortable that they're, the same company that's selling you this thing in your house is also selling an armed thing that goes around to find terrorists and crap. That's, that turned out to be their decision. So when they had their big peak, which was around here, we got out of iRobot. They had a peak, then they fell, blah, 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 blah. And I was like, as soon as they had a nice jump, I was like, okay, let's get rid of these guys, because there's 90 something, I think, when we got rid of them. And I was like, you know what, let's just get out, because I didn't feel like they were the same company. But they still, well, look what happened, actually. They did kind of fall apart. But still a very good company. But no longer, we haven't gone back in. LMT. So at that time, which I guess was more like 16, 18, to be realistic. So around here is where we started buying Lockheed Martin, around 200 bucks. And that's when it became, oh, there it is. In fact, see that volume spike? that's pretty much it, I think. So anyway, we picked them for stock of the century, our replacement stock of the century from iRobot. And again, a 10 bagger. So I'm saying this thing should go to 2,000. And right now it's still only at 436. So now, this recent action does not surprise me at all. It's the fact that it went down that surprised me. I can't believe it started coming back down to 375 and below 400, because people just don't see what these guys are doing. Let's see, Yeti. Ooh, do you see Yeti getting back to pandemic levels or bloody blah? Okay, whatever. Let's see, Yeti. I think the growth is still there for these guys. I don't think I think people just aren't seeing it, but the earnings haven't come out yet, have they? Yeti's they don't have early earnings. November 10th. So it's all rumors and speculation. They haven't said anything or done anything as far as I remember. Let's take a look. Are we done with this? Let's see if there's anything else important here. Marriott is acquiring City Express. Stocks pricing recession more than any other asset, but not enough. Ooh, see, and you still got people saying this. It's like constant negative bashing of everything in the market. Exxon raised to buy. I don't know about that. Generac full year guidance cut. That again, I don't think that's a big deal. Okay, that's good enough. All right, so what do we talk about? Yeti? Yeti. Wow. Really punched a hole in today. Oh, CFO stepped down. That's bad. Okay, so you don't like that. Yeti Holdings quarterly report. Their defensible case for Yeti. So they have the earnings on August, whatever. Here they are, August 4th. And we went over this transcript, so we already thought it was fine, that their plans were fine, everything seems fine. Guidance slash. Let's see what they guided to. Yeti sees full year revenue 1.6 billion, blah, 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 prior 1 point. So they actually raised their revenue guidance. Expected for the full year. Okay, so they had expected 260, and now they expect 240, let's say, okay, in the middle. Oh, prior view, the company had guided 260, but the analysts were saying 280, but the reality is now 240. All right, now don't forget this is back in, well, this isn't August 4th. What day is this? It's still August 4th. So that was what they said last quarter, when this is the reality of what they actually said. So the interpretation of what they said, 6 months, July, August. So the interpretation of what they said is to drop from 44 to 29. They said they're going to make 240 a share. That puts their PE down around 12.89 according to this. It's silly. Okay, when they said they were going to make I forgot the number now, 280, right? So when the analyst said they would make 280, okay, so when the analyst said they were going to make 280, which was here, they were trading at 51. Let's say 51. So 51 divided by 2.8 is 18 times earnings. So now they're at 29 divided by 2.4. So now they're 12 times earnings. So because they cut their guidance by 20%, the earnings multiple assigned to the company got cut by 1/3. Does that make any sense? And not only that though, but then you adjust it down for the stock price, so the multiple applied to the price is now ridiculously low. So that, you know, they've already guided down. They've already said it's bad. If they guide down again, that's a problem. But I don't really see that. I think there was a realistic guidance drop at the time. People don't like it when the CFO steps down, especially when he does it right ahead of earnings. I'm sure it's personal reasons. Yeah, business opportunity closer to family. They don't have a CFO, so when they announce a CFO, they'll probably pop back up a little bit. Effective. Oh, he's resigning after earnings. Wow, that's bad. Oh, it's not after earnings. No, it isn't actually. They're earnings in November, so they better find somebody. I don't know if you want to go into an earnings report without a CFO. But anyway, so that's people don't like that, and they're trading out of it. That's fine. I mean, this is why you buy things, right? You buy things because this is short-term problems, unless of course he's quitting because there's some giant scandal and that's about to break and everybody's going to freak out, whatever. But look, 16 million debt. That's nothing, right? They make 200 million a year, so 16 million debt is really not a big deal. This is a effectively no debt company trading at, yeah, there's the right number. See, Yahoo's wrong. Trading 11.4 times. I say Yahoo's wrong right away because these guys are way better than Yahoo. So it's 2.7 billion for the whole company. That is their guide down number is 208. See, there's two. In fact, it says 238 reported. So they're guiding 238. They expect to get back to 285 the next year when they were trading at 50 bucks. Remember when they were 285? When the projection was 285, they were trading at 50 bucks. Where the hell is August? Here they are, 50 bucks. Well, the scale is crazy on this, right? So they're trading at 50 bucks when people thought they were going to make 285. Now they're going to make 285 next year, but they're trading at 30 bucks. It's silly. People are very impatient. They don't want to hold on to any stock that seems to have any issues whatsoever, although all stocks have issues. It's just a question of whether anybody brings it to your attention or not. But my theory, and I could be wrong, is that I want to own stocks that give me a good return on my capital. And a return on your capital is this, it's your PE. How much are they earning for the dollar? If I pay $29.29 for my stock, how much am I making on my $29.29? So you take $29.29 divided by 11.4, and they're making $2.56 a share, which is the average basically of the 2 years, you know, the 2 years ahead. For the reasonable future, they're making $2.56 a share. So if I give them 29 bucks, they're going to make 2.56. Now, how will I get it back? I'll get it back through a dividend, maybe. I'll get it back through stock buybacks where they reduce the share count, so my share is more valuable as a lower share count. They pay it back They reinvest the profits, which is what you would do if it was your business, right? If it's your business and you make money, you take a certain portion of it and reinvest it. So this is what you're paying these people to run your business. And the value of this 256 years it accumulates should be, in theory, reflected in your share price. Although the sentiment of the market may cause that price to fluctuate, like whether or not people want to pay 18 times earnings for the company or 12 times earnings. Right now, they're paying 12 times earnings. I want to buy when they're 12 times earnings because I'm getting a great return for my investment. That's the whole point, right? When you're buying a stock, you're buying a proxy of a percentage ownership of the company, a very teeny tiny percentage ownership of the company where nobody knows you from a hole in the head. You can walk around saying, I own IBM, but that's a joke, right? You don't own IBM. You have a share of IBM. It's nothing. But that share of IBM has every right and entitlement of every other share of IBM, and you will collect that money. You will get paid the same way everybody else gets paid who is not a direct owner board member, who's not drawing a salary. You will get paid. Your benefit will be the value of the stock will be increased by the actions of the board. That's why you voted them in the first place, or somebody voted them in. The board is responsible ultimately to the shareholders to do as best they can. Now, of course, that doesn't always work out that way, but that's the gist of the matter. Anywho, so what was I going to say? Yeah. So anyway, so stocks like Yeti, low debt, also good employee ratios. We talked about a couple of things like that. Where was Yahoo? Statistics profile. I want to be profile. So Yeti has 800 employees. Okay. So Yeti has 800 employees, and they make well, it's going to be 200,000 per employee. They make 1,629. There. Nope. 123. There. Divided by 820 employees. 200,000 per employee. That wasn't hard. All right. So they make $200,000 per employee. That's not bad. That means you don't really have to worry so much about them having to raise somebody's salary from $35,000 to $40,000, right? That's not going to kill them. So, when you have 800 employees, let's try it again. You have 800 employees, and you give all of them a $10,000 raise, let's say, so times $10,000, that's $8 million. That's a nice fat raise to everybody in the company, only going to take $10 million off your 208. It's going to get 5% off. That means they have a low exposure to wage inflation. Also, if you look at the model and how they work, well, obviously they're dropping 10% to the bottom line. They're dropping more than 10% to the bottom line. That's increasing as they get more, so they're becoming more efficient, right? And that's because obviously their overhead is decreasing as a percentage of the total company's costs. Because when you're small and when you're starting, your SG&A is a very big percentage of your operating. And as you get bigger, if you do it right, you maintain you don't have to double up your SG&A if you double up your revenues. So anyway, so the debt is not going to affect them. Wage inflation is not going to affect them. They're a high ticket item, and they can control their costs pretty well because they choose, at the moment they choose to have the finest plastic, the finest coatings, the finest this, the finest. I mean, it's like it's like a Porsche. It's like the Porsche of cooling, of camping stuff. And you find that companies like that generally don't bother changing because in a inflationary environment, they don't seem to have that much problem. And also, though, if there's parts issues and so on and so forth, or supply issues, they have a pretty easy time switching because, again, it's not life and death critical for them to get this thingy from China. They're probably not getting this thingy from China. They're probably getting it from like master craftsmen wherever they are. And if they have to switch to another master craftsman, they'll do that. You know, top materials makers. They're not relying on, I can only survive like Nike. Nike's like, I can't survive without Vietnamese kids sewing my sneakers. Okay, there's no company. Like, you know, what are you, crazy? Where are we going to go? You know, Nike's got to go where the kids work. that's how they operate. Well, I mean, a lot of companies like that. Okay, it's like a lot of stuff in the world is made by, relies on cheap labor, and if you can't have the cheap labor, it's pointless. That is not the case with a company like this. So I like it. And also, another thing, they cater to who? The top 10%. The top 10% are not affected much by inflation. Don't care. Okay, this my Yeti I happen to have right in my hand, my Yeti cup, which I've already said I feel like I get my money's worth out of it. It cost, I believe, $30. If I put ice in this cup, if I put like a third of the cup of ice, and I put tea in it, or water or whatever, and I put the lid on and I close the top, which sometimes you forget to do. But if I close the top, which snaps shut, hear that? It's very funky. That's because it works on magnets. The little thing that opens and closes the lid where you drink is not. It snaps back and forth because it's a magnet. It snaps it back and forth and keeps it in position. A magnet in my cup. Anyway, so I've had this thing for well over a year. It must be 2 years now. I use it all the time. So I think it's a very well spent $30. It is the best thermos. Oh, I was going to say, so I put a third of a thing of ice in it, fill the rest up with whatever I'm drinking, put it by my bed. The next morning, still ice. What more could you want? Same in my car too. It doesn't care. It doesn't care if it doesn't care. I put it in the car. It doesn't care if I leave it in the car overnight. It's the same thing. Like if I'm taking it with me on the road and I leave it in the cup holder of my car and I come out the next day, I have a cold drink still in my car in 90-degree weather. It's freaking amazing. Anyway, so Yeti, I like this. So anyway, so do I care if it's 30 or 35? Not really. That really isn't the point when I'm going to buy one. It's like it's not 20. 20 is what they cost in Dunkin' Donuts for something similar, but it ain't no. Or Starbucks are practically the same $30. So you know. But Dunkin' Donuts has ones like this that are more like $20, but they suck. They're useless. This one is great. So anyway, so that's the point. So people in the top 10% are going to buy them regardless. They're not going to sit there and stop buying them. And the analysts don't get that. The analysts don't understand the difference. All right, so we still like them. But by the way, if they're at 30, 15, I mean, you got to roll down though. If you're going to stick with it, you can't stick with it and just pray it gets back to 50. If you bought it at 50, you've got to make a commitment to roll down. If you don't want to spend the money to put yourself in the right position on the stock, then get out. But that decision should have been made a long time ago. Basically, whenever you're down 20%, you have to make a decision right then and there to either cut your losses or commit to when it's down 40%. Maybe it won't be, and if it never is down 40%, then who cares? Then you're okay. Your stock's down 20%, it'll come back. But if you are down 20%, you have to relook at your position right now and say, I absolutely want to buy more or double down or reposition, whatever. I want to put more money into the stock if it goes down 40%. Because if you can't say that definitively, you should get out at 20%. You don't like the stock enough to keep it. You can't cross your fingers. The second you cross your fingers and say, I just hope this one comes back, you made a mistake. Now, not that we don't make mistakes also, because what we do is we'll double down, and we will then and we'll look at the portfolio soon. We'll take a look at that. We will double down, we will roll whatever, and maybe we'll do it again. It goes down another 20%, and we do it again. And now we've got a pretty big commitment, and then it goes down another 20%, and then we say, okay, that's it, we're done. But now we're done with a big loss, but that can happen. We thought it was going to turn around, it didn't turn around. At a certain point, you still have to say, I'm not willing to go anymore. And that's when you have to cut it, though. You have to cut it at a certain point. Oh, I'm sorry. But then sometimes at that point, we may say, well, it's not worth selling because we're down 85%. So it's possible if we're down 85%, but it still has like 2 years and a half to come back, we're like, okay, well, we'll leave it. It's probably dead, but there's no point in recovering 15% of our money. We rarely do that. We're doing it with Wader Holdings right now, though. We have WTRH, and they went, oh, God, total disaster. WTRH. You know, they pivoted, and then they pivoted, and then they pivoted, and now they don't seem to have a plan or any idea what they're doing. So they were going to do this, then they were going to do that, and we thought they were going to turn it around, and then they crashed right back down again very recently, right? They went really tumbling down, and now we're just sort of stuck with them. So, because now there's no point in saying, you know, there's no point in getting them back, but it is possible, conceivable, they could pop back up. Then we might do something with it, but right now it's just like, I'm not putting another penny into that. Look at the bankruptcy risk; it's off the charts. I mean, they got no money. They're screwed. Nothing they tried to do worked. Basically, they have 36 million in debt. They have 28 million in cash, but they're burning 96 million. So tick, 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 tick. They are eventually going to go boom. So unless somebody steps in, but steps into what? It's just a disaster. So unfortunately, okay. Anu says, if you have time, could you talk about hedging? I will talk about that. We'll look at the short-term portfolio. Yeti and GNRC are down 71% from their highs. When do these stocks start trading on valuation and not from macro headwinds? How did the market get the pricing so wrong on these stocks? Maybe they're not wrong. Maybe they're not wrong. Maybe we're wrong. Maybe somebody sees something we don't see. But, you know, I mean, look, for one thing, we didn't buy it when it was at the top. It was stupidly priced at the top. Who's this waiter? You know, I wasn't buying Yeti at 100. It's like GoPro, right? GoPro used to be crazy high. I just got into GoPro because it got so cheap, and I'm like, okay, at that price, I like them. Didn't like them up here. I always thought that was stupid. Even Tesla, it's almost coming down to a point where I'm like, oh, that's not so bad. Finally, Tesla has come to the point where I'm like, oh, well, maybe I can make a case for this. I'm not, but I'm thinking about it. I keep looking at them and go, We bought Tesla like at the beginning, like way over here, but we got out. We bought Tesla, you know, whatever this is, $20, right? So we bought Tesla way down here. It went up near 100 and we got out, and we were like, in fact, I think here probably, no, that's only 50 something. Somewhere around here we got out, and then it just kept going up and up and up, and I was like, grrr, because it went up and up. In fact, we ended up shorting some of it, and that was a disaster. So we got squeezed out there. I think we shorted it, and some people, we held on, but some people just got squeezed out and couldn't stay in. I could understand why too. It was a horrible loss. You know, we took a big hit on that. Because and again, it's the same thing though. It's like if you aren't willing to press your bet, then you should have gotten out here. You know, when you take the loss, you've got to say to yourself, you have to say, I'm sticking with this short. And that means that if I say I'm sticking with this short, if it goes up another 50%, I got to stick with the short. I got to do what I have to do, not just stick with it and pray it comes back, but take advantage of the move. And if you can't do that, you shouldn't be in it. Then you should be cutting and running. But anyway, so then it went up and then it went down. We were thrilled to get out. We basically didn't play them again because we were so pissed off at this horrible thing that happened to us. It went all the way up. Then we shorted them. Then we had a great short, made a fortune here. This because I was like, this is insane. That was not too long ago. That was, well, it's only recently actually. We caught this nicely, and it was insane. And we still have a leftover something for Tesla, I think. Oh no, I think we're done with them actually. But now we come all the way back to 200, which is frankly again where we shorted them back here and got burned like crazy. Now they're getting a little bit interesting, but I mean only interesting in that if they mess up and it drops hard, I'm going to then be seriously interested in it. But that will depend, of course, on why they're dropping hard. But now they're making money. Look, $13 billion, $20 billion projected. I wouldn't trust any projection of Elon Musk at all, but you could see where it can come from because they've got the Model 3s. And I think I mentioned last week, every time I take an Uber now, well, I'm in a rich part of South Florida, but every time I take an Uber, it's a freaking Tesla. And the guys love it. I talk to the guys and they love their cars. It's mostly Model 3 people because, you know, economically. I don't know what the Tesla lease is for. An interesting. I think there's some kind of deal with Uber that they help you with it. Tesla Model 3 lease $549. Yeah. Then carefree car subscriptions, fixed monthly, everything but fuel. Order your car online. Blah blah blah. There you go. That's better. There you go. 458. There you go. That's totally. See, there you can see where an Uber driver can make money, right? 458. No or low gas expenses. Electricity is actually pretty cheap in Florida for whatever reason, or compared to New Jersey anyway. I haven't done a survey of the whole country, but I'll tell you for one thing, it's not even a third of what I paid in New Jersey. So, and of course, you're not going to be if you're driving your Uber, you're not going to be picky about your model, your colors, and things like that. You're going to get what they have. So, you can do a lease and get 458, and how many rides do you have to do to make that kind of money, though? 458 a month. I don't think they make more than, let's say they make $5 a ride. That's 100 rides. Oof. It's brutal, right? So 100 rides, 20 rides a day, 2 rides, 10 hours, 2 rides an hour. No, that doesn't make any sense. Am I doing something wrong? Well, that's a month. That's why. So it's a month. So if you make $5 a ride, that's 100 rides. But what if you want to make, so your car costs $500, and you want to make $500 a week. So you've got to make $25,000. Not $25,000, $2,500 divided by $5 a ride. 500 rides divided by, let's say, 20 days, 25 rides a day. You gotta go from ride to ride to ride. I mean, you're gonna pick up. Well, that's true though. If I take an Uber, it's usually like 15, 20 minutes. Still, I don't see the point. It's not for me anyway. Anybody done that? Has any of you guys done that? It'd be interesting. That just doesn't seem to work. I mean, having alternatives to that, I certainly wouldn't do that. But Jackie does DoorDash, my daughter, and she makes $100 and sometimes $200 a night. So I think you're way better off with DoorDash. You know, she's up in Hoboken though. That's also a good area to be in. But yeah, because people just sitting there like waiting. You know, it's so funny because towns where like you can walk down the street and get food, but no, they're gonna call DoorDash. The biggest problem is parking over there where she is. But she can make 100 a night. Well, that's there you go though. It's about the same, right? It's 100 a night, but she makes it in like 4 hours, so she's making good money. I can't see how an Uber driver can possibly make that kind of money. Maybe though. Either way, see, and Jackie's always complaining about the gas. And if you can actually get an Uber for 500 a month, that's probably smart. I don't know. Anyway, so what else? Questions. We're going to look at the portfolios. That's right. So down there, discuss that. Great. Look, it's like the economy, because you know, I was saying that before. I mean, my big worry right now, and I'm reviewing the portfolios. This does not include any of the new trades yet. So we got. Oh, let's talk about hedging first. Hedging, short-term portfolio. Yes, okay. And this does not include any of the changes. Oh, let's look at it this way. That's a good idea. Where's PhilStockWorld? PhilStockWorld. Portfolio review. Unavailable. What? What does that mean? Are you guys having this problem? What the frick? Whoa. Oh, that's probably something I had. Wow, this is all right. Are you guys down? Can you get in? Oh, that's not good. What is happening? Shit. Phone. It's working before. I'm gonna get out of the computer before I start freaking out on my programmers. Nope, getting it every time. Okay, sorry. Trying to find. Okay. Why does that happen now? Trying it again to refresh. No, the webinar computer. I'm out of the computer. Oh, man. Oh, Eileen says she can't get on either. Son of a bitch. 503 service unavailable and 504 gateway timeout. Period. Not just me, everybody in the webinar. What is going on? Oh, all right, site is down, can't get on. Yep. Oh. All right, anyway, at least we can keep doing the webinar. So back to this strategy, short-term portfolio. I was going to say, because I already made notes about what the changes should be in the webinar, but if we can't access it, that's not going to help. So, well, all right, so what's the real question, though? The question was, before we got interrupted, could you talk a bit about hedging, a brief overview? Okay, well, okay. So, I'm just trying to think of what to say about it. You know, the way we do it, it's and it's a good way to do it in any system, because if you keep your hedges separately, you can focus on what your hedging portfolio is like and how it responds to market moves and so on and so forth. And it's not just some big blob with everything else. And most trading platforms let you set up like multiple accounts, like you can segment your accounts and then move back and forth between them. In Thinkorswim, there's a tab there. See, it says all accounts, and you have different accounts. So you can do it like that, and that's just flip between account to account. You know, if you have to get two different trading servers, get two different trading things. I mean, it doesn't matter. It's the point is, it's a better way to do it because you're not mixing in your longs and your shorts and trying to figure out how well your hedges are working all the time. These are our hedges. So when the market drops, we want to know how much it dropped and what was the response. So anyway, so we have, these are our primary hedges, 700 of the SQQ 50s, right? Against those, we've sold, on the SQQs, we sold all these. And I think my determination was we need to be more bearish, because I don't like the way that we keep stopping and starting in the markets. And in fact, well, we're turning around here, but like I said, it doesn't take much. Anything like every time one of these Fed people opens their mouth, even though they say the same thing over and over again, there's no difference to what they're saying. It still seems to get the same reaction from the market. You know, ice is cold, ice is cold, fire is hot. It's like, we know, okay, stop saying it. They just constantly, we're not done tightening. I guess they want to make sure it's a clear message, or I guess more to the point, they want it to work. It doesn't work. You know, when the rate is 3.25 and you say, oh, we're dead serious about fighting inflation, you don't seem that serious. 3.25% is a joke when inflation is 10.5%. Because what is an interest rate? An interest rate is something you get, you know, you give someone your cash. It's a loan. And they have drilled this out of you as a non-banker. And you know, you're not in the club, you're not a banker. And they have, through marketing and through terminology and through the media, they have drilled out of you the idea that you are lending the bank your money. They never say that, right? They never say we borrow money. Jimmy Stewart said it in It's a Wonderful Life, but banks don't want you to think that way. And they have drilled it out of people's heads where it's hard to even wrap your head around the concept that you are lending money to the bank. Your savings account, your checking account, your IRA, you're lending money, your money that you work for is, instead of being in a pile of cash in your house, they have convinced you that you are better off giving it to them to hold. And yes, obviously to some extent you are, although with electronics these days, honestly, no. That's why you have all these e-banks coming around, because why? What are you doing? In the old days, they used to have big giant vaults and guards and so on and so forth, because money could be taken. Someone could come to your house and take your money. You don't have any money in your house. You don't need money in your house. So why are you giving your money to them? Your money only needs to be put in a secure website. Okay, which brings you back to something like Bitcoin, right? Your money only needs to be in a place where you can access it, but not somebody else. It doesn't have to be in a bank. A bank has no purpose. They do nothing for you. Your company electronically transfers money. They could transfer it to anything you want it to be transferred to. That's how you get paid. And then you take that money and you decide what to do with it. You don't need the bank. They facilitate stuff and they do stuff, but there's nothing a bank does that any decently written app can't do. And there's regulations and so on and so forth. But again, effectively, that's what Bitcoin is. I don't want to keep checking this, but I have to, and it's going to annoy me every time. Yep. Fuck. Excuse me. I'm just pissed off. Hang on a minute. I got to try him on the phone.
Hello. Please state your name after the tone, and Google Voice will try to connect you.
Bill.
You've reached Scott Campion. Please record your message and I'll get back to it as soon as possible. Thank you.
Hey, when the site went down momentarily, you said not to worry about it. Well, now it's down in the middle of the day. You can't go. I'm in the middle of a webinar, but we need immediately to take care of this. Thanks. Because we did go down briefly the other day, and he said, don't worry about it unless it happens again. Happened again. All right. Anyhow, what was I talking about? Damn, can't remember. Anyway, so hedges. The point is that we like to trade these ultras. Now these are messy because they've gotten messy over time. But the crux of this trade is you buy the $50 calls, and they're currently $25, $26, right? You sell the $80 calls, and they're 21 to 28. So what do we see? The other one was 26, and these are 20, and these are 20. So let's just say 20 and 26. So $6 for the spread. It's a 50-80 spread, and currently we're $8 in the money. Right. So in other words, if SQQ doesn't go if the NASDAQ doesn't go any lower and SQQ stays at 58, then you're going to get back $8 on your $6 spread. So the spread is already more in the money than you're paying for it. That's a good start. The spread also has, since it's a $30 spread, the spread has $22 of upside against your $6, right? So you got 22 divided by 6 is you can make 366% if the NASDAQ goes to 80. Now, will the NASDAQ go to 80? Well, 80 Minus 56 is 24, so it's about half. Divided by 56 is 42%. Now we divide that by 3 because it's a 3 times ETF, and it's 14.2%. So if the NASDAQ drops 14.2% from here, and we're at 11,000 now, then you'll be at 80, and these guys will be worth 30 bucks each, $2.1 million. But then your short calls become an issue, right? And that's why we made some adjustments and fixed it over the, in the portfolio. I can't show you. I'm so annoyed. Oh, you gotta be kidding me. Where was I? So anyway, so we went through all these adjustments, but the point is you find a balance that's going to work for you. And in this case, before we start paying out any of these short callers, and I don't remember what we did exactly, but I wasn't worried because see, these 70s are 21.70 and these 80s are 20.28. So it only costs like $1.50 to roll the 70s to the 80s, and it only costs $1.50 or less to roll to the 90s. So for $3, I can roll these to the 90s. For $1.50, I can roll those to the 90s, and then we've got another $700,000 worth of coverage. And I'm going to spend, well, whatever it costs, but I'm going to spend, let's say I spend $2 total on 1,600. So spend $320,000, right? So it's 200 times 1,600. Yeah, so we spend $320,000 to buy an additional $700,000 in coverage. It's not ideal, but what it means is, though, it's very unlikely we're going to get that burned by the NASDAQ, that the NASDAQ's going to go to 100 and whatever. And don't forget, that means that now you'd be getting 40 bucks here, so you'd be getting $2.8 million before we have to give anything back to the short call. So in other words, it doesn't matter if it hits 90, if I roll them up tonight, it doesn't matter if it hits 90, it only matters how far over 90 it goes. So as I said, though, we're at 11,000 now on the NASDAQ. And we said it would be 14% drop in the NASDAQ, so times 0.86 would be 94.60. So then we go over to our NASDAQ chart, which is here, and we say, does that seem realistic? Do we think that we're going to get to 94, right here, 94.86? Are we going to fail this line and this line? Are we going to go that far down? And this is the weekly, by the way. And so at the moment, we're still holding 11,000, I believe. Where are we? 11 something. 10.9, last 11.086, right? So we're still holding up. Yeah, 11.131. So I'm fairly confident that we're going to get back over this red line here. This is the 200-week moving average. I think this thing is going to turn back up. Then there's going to be, this will turn up a little bit. And so we're going to get some kind of rally in here. And again, if earnings are not too bad and everything else stays the same. But the problem is I can't be that sure. And this is where I'm starting to get a little worried because we're really, really weak down here. The Fed is definitely going to tighten. And basically, no matter what happens, they're going to keep tightening. We're not sure how bad the winter surge of COVID is going to be. We're not sure how the war in Russia is going to resolve. China's in a shutdown mode right now. Russia has declared martial law, by the way, in all the Ukraine territories they control. And also, I think in Moscow, there's some kind of limited thing. There's some sort of restrictions. So it's pretty tense. And of course, China and Taiwan and all that crap, because he just made aggressive moves talk about Taiwan. There's a lot of crap going on. And it kind of makes me think that if this fails, and by fail, I mean, if we, it's too long on the NASDAQ. So let's go back to the S&P. So we're still over 3680. So I'd be very concerned if that keeps failing, because then it means we're probably consolidating for a move lower. But it's the same thing though. Short term, we should be coming into a bit of an uptrend. And if we're not, and we can't get over 30, if we can't get back over 3860, or 38.40, sorry, 38.40. If we can't get back over 38.40, in other words, if the W fails again, if this fails to form and 3,800 becomes a top, and we can't even get to 38.40, so we don't even, if we don't start consolidating up here in a very short amount of time, it means this 50-day moving average is going to fall below here, and that's going to put us into a much worse territory. This will start declining more rapidly, the 200-day moving average. It's going to pierce the 4,000 line, and that means basically we're in a market recession, regardless of anything else that happens. And there's no reason for us to ride that out. You know, we're better off because we have, between the short-term portfolio and long-term portfolio, we have 4 million in cash. I would rather have cash. Even if we're going to go back and buy the same positions again, I'd rather see where it ends, because I learned my lesson in 2008. Things seem cheap, and then they get cheaper, and then they seem cheap, and then they get cheaper again. And there was absolutely no logical reason whatsoever that Apple should have been effectively $7 a share, because it was a 10-time split. So Apple was $7 a share against the current price, which is like 140. So 1/20th of where it is now. You know, Ford was $2, GE was like $10. It was ridiculous. It was just, you know, insane prices that had no rational basis whatsoever, but there they were. And not for a day or two. We were like trading for 6 months near that bottom. From basically November until March, we traded around that range. And it was horrible, and it was depressing and ridiculous. And we took full advantage, and we bought like crazy, but that's because again, it's like what it is now. We pulled the plug when it failed the range here, which we had back, you know, the different range, of course, but when it failed the range we had in 2009 in March, I'm saying not in March, in 2008 on the way down, when it failed that range, instead of drawing another range 20% down and saying, okay, now now cross this line like Bugs Bunny, right? Now cross this line, now cross that line. No, you have to say, okay, we called this wrong. We're lucky that we have a fairly well-balanced portfolio. Like, we had $4 million here total in our long and short-term portfolios. We have $4 million here total in a long and short-term portfolio, but they flipped. Because the long-term portfolio used to have, what's this, 2.5. So the long-term portfolio used to have 3 million something, and the short-term was 1 million. Now, oh, this is a short-term, sorry. So the short-term used to be about 1 million, and the long-term was 3 million. And now the short-term is 2.5 million, and I bet the long-term is 1.5 million, right? What? No, strategy. Long-term. And long-term is, yeah, 1.5. So it's the same 4 million, but they flipped. And that's what hedging is about, right? It's the idea is to maintain it, but you've got to be careful not to overhedge, and that's the art to the whole thing. So what we do with the short-term portfolio is we flip our positions here, and this is also, by the way, the beauty of it. I don't have to constantly go in and out of my longs. What we do is, in the short-term portfolio, when we think we're at the bottom of a channel, oh, look, ha! Hang on, I got to tell Scott it's back up. Oh, just spoke with WebAir. They're having problems with their data center and are working to resolve them. The site will be back up soon, and you'll receive an email about it. They also said you should have received an email about the problem. Yeah, I'm in the middle of a webinar, dude. I'm in the middle of a webinar, so I don't check my mail, period. Nor do I ever. It is back up now. So it's a stupid service provider or web host or whatever you call them. All right, good. Now we can take a better look at these things. Okay. I think the short term might have been about the last one I did. Yeah. Yeah, okay, good. All right, so the short-term portfolio. Okay, so let's just go back over what I said. That's easier. And again, this is right there in the portfolio review, so you'll see it. So the bulk of our protection is the $50 calls that are up $602,000. Looking below, and what I mean by looking below is looking below here. So in other words, the first thing I talk about is SQQ, but most of the trade is down here. This got detached, and that's because there's like, sometimes we have two sets and we change one set, and sometimes there's a limit on how many things that can be put on a set. Not sure what why this got detached, but it's detached. Anyway, so I said looking below. See if we can get those into view. Oh yeah, well, I can get those into view. You need to remember the other ones. We have 300, 2024, 30 calls, 300, 202, 2024, 50 calls. And I'm talking about, oh, I wrote $300. We have 300 of these and 300 of these. Those are longs. We have 700 above, right? So that's 1,300 total long calls. We have 11, 5, 16, 18 short calls. So I said we have 1,300 longs, 1,800 shorts. But the longs are so much deeper in the money. Because now these are 50s, and wait. These are 50s, and these are 30s. All right, and I said, I don't see how we can pass up this chance to take the 30s off the table. They were $940,000. So I said, let's take those off the table. But we don't just take them off the table, because then we'd be ridiculous. I said that leaves us with 800 extra short calls, but that's crazy. So what we're going to do is buy the 2025, again, a $30 spread, because that seems those tend to work the best. But the 2025 spread was only $350. So it's crazy not to take that when we have a chance. So we took 500 of those. So we replaced 300 these, 30s. We replaced these 300 with $530 spreads. So the $530 spreads is 1.5 million. The 300, if you hit 80, would be 1.5 million. Whoops. So it's the same amount of protection, except these only cost $175,000 has been horrific. It's been up and down and whatever, but the bottom line is for the NASDAQ, 2022 has gone from 16 to 11. That's basically 30% down. Meanwhile, oh, it was here, wasn't it? That's right, before we started with this crap and it wouldn't work. Do I have it? Oh, you can't tell what chart it is? Oh, there's QQQ finally. Okay. So meanwhile, 400 to 270, it's the same 30%. It's the same 30%. Now if we put the S back, and that comes right up. Isn't that weird? So keep that in mind. Look at 2022. It's been flat, right? But the NASDAQ fell 30%. So they should be up 30% and started the year off, well, it's hard to tell like that. Give me something I can actually see. Oh, you're not QQQQ. Select chart view as gallery view. Whoa. Oh, and you put symbol here. NDX. Here you go. All right, so that's not NDX for one thing. Why are you being like this? Select chart, select list. I don't want default. Oh, I get it. See, I'm not used to looking on this computer at this thing. SQQQ, that's what we want to do. Where did SQQ start the year? So this is a good example of decay. So we started the year at 28, okay? And the NASDAQ fell 30%. So that should be a 90% gain in, well, it is, shit. Proving nothing. Okay. It's interesting how different it looks on that chart. All right, no, I apologize. Okay, so basically it did what it's supposed to do, right? It's a 90% gain. It's a, 56, 57 is basically 100%. So it did what it's supposed to do, but take my word for it. Over time, these things decay. These ultra ETFs tend to decay, and because of the constant churn, the fees start eating into the product, and they don't hold their value the way they should. So that means that in a year where the NASDAQ goes down and down and down and down, you're going to get your money's worth out of the ETF. But as you can see, it was higher here, then it went down, then it went up, blah, 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 blah. All this churning starts eating into it and it eventually peters out. And they recast these all the time. They're always doing reverse mergers on these things, reverse splits, because they actually get to the point where they actually have zero value. I wonder how TQQ is doing. That's a good question. Let's change that to a T. That's the ultra long ETF. See, and this is the one that's going to get to a point. If it, if the NASDAQ keeps going down, this will go to like below $5. Once it goes below $5, they'll do a reverse split on both of them. They'll do it on SQQQ and TQQQ. So they kind of have to do them at the same time. So we will see what happens here. But when you get this relentless down, down move, that's when you're going to get the value out of your ETFs. But in a flat market, they start to sort of deteriorate on their own. And that's a big advantage though, because when you're selling, that's the thing, when we're selling the short calls, we have a huge decay advantage over the people we're selling it to. So anyway, point being though, in order to get from here to 80, like I said, the NASDAQ has to drop 14%. We simply just don't see that as being a realistic number. We don't see getting to, I forgot the number now, is it 86? No, it has to be 96, right? It was 96. It's 11,000 times 0.86. 94, yeah. So we don't see that realistically because we're not seeing it yet. But like I said, you've got another, if China significantly starts shutting down again, that then you're right back to the supply chain. Then the supply chain is shot, right? And that's done. It means COVID is spreading and it could come back around again, which means that we're going to need more trillions of dollars to be spent on bailing people out and so on and so forth. And a lot of businesses are really on their last legs. I mean, they can't take it. It doesn't matter if you try to bail them out. I mean, they just can't take it anymore. And you see this. You walk around towns and you see all the empty retail space. It's bad. And if we have all the office buildings again and the workers can't go to work, so on and so forth. And not only that, though, but the ACT test, I don't know about the SATs, but the ACT test for the kids for high school to go to college, lowest scores, I think, ever from this year's testing. Why? Because the kids missed 2 years of school, or they kind of sort of had 2 years of school remotely. There's a huge loss there of education. And it's being immediately reflected in the test scores. And what's going to have to happen is these college teachers are going to get hit with these kids who are missing a lot of the basic things they expect them to know. That's what the test scores reflect, right? They don't know what they're supposed to know. You can't teach them what you're supposed to teach them. And you end up throwing less prepared people into the workforce. And that diminishes our workforce and diminishes productivity. We're already seeing shitty productivity numbers. That's another big thing we got to watch is what the productivity report is when it comes out. So we've been getting some terrible productivity numbers. So there are a lot of things that could go wrong. So again, I was saying before whatever, oh, I know we started talking about the hedging. So I think if we get back up to here and we fail, that's a very big cash out signal for me, but it's also a cash out signal if we don't get up to here. So unless we get back over here and break over that 50-day moving average before it fails the week retrace line, which is it's only got, how long does it have? Okay, I'm sorry. You see how they're like 200 points apart, right? So they're 200 points apart. And this is the 50-day moving average. So it moves 4 points per day. So this is going to come down 4 points every day that this is down here. This 906 is above 3650, 3850 by 50 points. So we have 10 days, not more than 10 days, 15, let's say we have 15 days before this hits the fan. So in 2 weeks, after 2 weeks of earnings, if we are not above the week retrace line, if this index isn't above the week retrace line, then this is going to absolutely come through this, through the 3850 line, the 50-day moving average, and we're in big trouble, technically in big trouble, and realistically in big trouble, because it means that the earnings didn't justify a move back up. And so once again, cash out. Because cash is your best protection in a situation like that. You don't know when it's going to stop, but it's bad. And I'd rather have $4 million of cash on the sidelines than $4 million tied up in a portfolio. No matter how well hedged your portfolio is, you're still better off with the cash. Because when push comes to shove and everything's down and whatever, you're still going to be able to buy Yeti. You're still going to be able to buy, what's my favorite? Simon Property Group, SPG. Holy crap. Simon Property Group is the mall guys. Upscale malls generally. Okay, they've gotten clobbered. They went from forget anything in between. You just don't want to pay attention to that. You want to say they're about 140, and they're down they're down at 100 now, so they're down 35%, something like that. That's not at all what their business is like. Their business is great. And these guys pay a $7 dividend or something like that. SPG. Let's go on Yahoo and see what their dividend is. Dividend, $7, yeah, $7 dividend. Their PE ratio is 15. Their occupancy is great. Everything is fine with these guys. And numbers. No, not SP plus, SPG. So $32 billion. They make $2 billion a year. Very steady. Look how steady though. Boom, 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 boom. Now, I love companies that made money during the pandemic. They have a lot of debt, but they're builders basically. They maintain properties, so you have to look at them differently. They've got no problem covering it. We looked into all that stuff, and that dividend, they could always use that to pay it off. The dividend is gigantic. But they're a REIT. That's why they pay out most of their money. They pay out most of their money in dividends. They're like a REIT. So they're basically just very underpriced and an excellent company. And the other fun thing about them is the options are outrageously expensive on these guys. If you go out to 2025, like here's the stock. You buy the stock for $99, right? Then you sell the 100 calls for $17 over here, and you sell the let's say the 80 puts for 13. So 17 and 13 is 30, right? So instead of buying it for $99, you're buying it for $69 net dollars. Okay, so that means that if you get called away at 100, you're going to make $31 divided by your $69 net dollars that you're putting in. So that's 44%. So you're going to make just under 40. So you're going to make just under 45%. By buying the stock for $99, selling the $100 calls, and selling the $80 puts. So your worst case scenario is it goes down and you get assigned another batch of shares for $80, and you'll average 90, right? Because you're in for 100. Oh, you won't average 90. You're in for net 69. Your average would be 69 and 80, so basically 75. So your worst case scenario is that you own the shares at 75, 2 times the amount of shares that you're buying now, and that's not a terrible case given these guys, because now your PE is below 10. And meanwhile, they're paying a $7 dividend. If you bought the stock for net 69, then your dividend payments are 10% a year. So on top of the 45% you'll make if you get called away at 100, which is where it is right now, you're also going to get 20% more in dividends over the course of 2 years. So that's going to be 65% in 2 years with a totally conservative play on a REIT. And so the trick is, whatever the amount you want to buy, don't buy more than half and then do something like that. Then sell the puts, because if the puts get assigned to you, then you will own the full amount that you intended to buy, but you'll own it at $75. You'll own it 20. You'll see savings. So your hedge in that case, it's almost self-hedging, because even if the market drops and this thing goes down 25%, you're still okay. That's your net average price, and you're going to still get your dividends unless they, of course, cancel them. But you're going to get your dividends too, which is going to knock another 20% off your price. So your worst case really is 69 minus 14, which is what, 55? 55. So your worst case, this is a $99 stock. Your worst case, if they pay out the dividends for 2 years and you get assigned net 75 average, your worst case is 55. That doesn't sound right. No, because it's 75, because it's your average price. It's 75 less the 14. So it's 61, sorry. It's going to be $61 would be your net cost overall, including the dividends, which is still basically 40% off the current price in just 2 years. So you're either going to make 65% if it's over 100, or in a disaster, you're going to get the stock for 40% less than you had now. So that, by that logic, if you start off with a half a commitment. So let's say I was going to buy 1,000 shares for 100,000 bucks. Instead, I'm going to buy 500 shares, and I'm going to commit to selling the puts and selling the calls. And then if I get assigned at 70, if I get assigned at an average of 75 and I collect my dividends and I'm down to 61, right? Then I've got 1,000 shares at 61, so it's only $61,000. Then I'm going to sell puts and calls again against that, and so that's going to be minus, I'm sorry, I said 500 shares, didn't I? Yeah, right. So you'd be in for $61,000. So you're in for $61,000 because now you have 2 times 500, which is 1,000. Don't forget, we started with $100,000. That's what you call an allocation block. So I've allocated $100,000 to the trade. I'm now assigned the stock at $61,000. But what do? I turn around and I sell more puts and calls. Now, maybe I won't get, what did we get before? We got 30 bucks. So before we sold $30 worth of puts and calls, and in this case, it would be $30,000. But let's say we only sell $20,000 worth of puts and calls. Let's say we don't get as much money because it's lower. So then you say let's say minus 21,000 to make it neat. So it's 40,000. So now I'm left with, so now I've sold more puts and calls in the same scenario where you're going to make the same money in the next cycle. If that's what I decide to do, I could just take the loss and give up. But if I decide I want to do that, then what am I doing? I'm now committing myself to double down again, but my double down again is going to be, well, if we're starting off at 61, my double down again would probably be around 50 or maybe 45. So the point is, if I have to double down again, it's certainly going to be at a lower price than $40,000. Not low, I'm sorry, not low, but it's going to be between $40,000 and 60. So it's going to be no more than 50. So I've still got my $100,000, except if I get fully assigned for 2,000 shares, they're going to be 2,000 shares at $50 each, $100,000. And I now have twice as much as I would have bought here. But at no time have I really dampened my probability of getting a good return on the stock. So it's a fantastic way to play. You just have to get used to it because there's a lot of moving parts, all right? But that's exactly what we teach in every day in the chat room. That's exactly the kind of trading we teach you to do. But this stock is just perfect for it. Could not possibly be better because it's got big fat numbers. It gives you huge returns for not, you know, for the stock on the options premium, and also it pays you these fat freaking dividends that are incredible. And it's a super reliable stock that didn't even lose money in 2020. Didn't make as much money, but it didn't lose money, which is key. And why? Because they have long-term rent contracts. The mall was closed. It was closed most of the year, still made money. Didn't go out of business because of COVID lockdowns. That's a pretty bulletproof investment, and it's got a lot of potential for the long term. And again, what do you do? What are you buying in the end? You're really buying real estate, right? You own real estate. You have real estate. You built malls on the real estate. You charge people rent to have spaces in your malls. That is not going to, as much as they talk about Amazon and all this shit, it's not going to go away. That experience isn't going to completely go away. And again, I wouldn't invest in the mid-level malls because those are kind of crumbly and whatever, but that's the thing. You're catering to the top 10%, the top 20% of these kind of malls. It's, you know, the Neiman Marcus and the Saks Fifth Avenue and the Macy's and things like that. It's the upper scale stores and, you know, and all the yuppie little things in between that go there. And they have and these are big companies that are also not likely to go out of business. Therefore, the rents are going to keep getting collected. And for the most part, and you know this by walking through these malls, for the most part, somebody goes out, somebody comes in. Somebody always wants to be in the good mall. So this is a good investment. I like them a lot. So let's see what else. Where were we? I'm sorry, we were talking about hedging. That's right, we were talking about hedging, looking at the short-term portfolio, and then we were able to access this. And so then with TZA, I said, let's not let the 300 short. So the only change in TZA is I'm a little worried about getting burned on a move up. So I said, let's not let the 300, what 300? 202460s. 202460s. Oh, I see. There's two of them. There's 100 and 200. All right. So I said, let's not let these 300 calls go over $13. So they're at 11.23 there, and now they're at 12.55. So in other words, it's getting close to our stopping point because we're back under 17.50 on the Russell. So if these hit $13, we're going to buy them back for $400,000. But look how much cash we have. You know, we're sitting around with all this cash. We're going to buy them back for $400,000. And then we'll be that would make us that tilts us then much more bullish. It's like balancing weights. Like you're trying to, like, if you have, like, weights on two sides of a scale, and you just sort of like take a little bit off and it tilts one way, you take a little bit off the other side, it tilts the other way. That's how you get more bearish and bullish. And by doing that, we're able to steer our entire portfolio bullish and bearish day by day by just making these one single changes just like that. Like I say, okay, so if we get worried and these hit 13, then we're going to take these off. That knocks us down to, then we have 400 longs. If we get rid of these, then we're left with 400 long. And it doesn't change the balance of our portfolio, it just changes the cash, right? The balance is a balance. So if we take the cash and we get rid of these, we still have the same cash, we still have the same balance. It's just that we moved cash from here to here. That leaves us then with 400 of the 40s, and we're at 40 with TZA, and against 600 of the short 70s. So that's $30. So we would have to be $1.2 million in the money on the 40s before we would have to pay the 70s a penny. And what's the net of that spread? The net of that spread is 633 minus 685. The net of that spread is 0. So if you take this spread right now and sell 600 short calls, 600 short 70s, and buy 400 long 40s, the net of this trade is actually a credit of $50,000. You get someone will pay you $50,000 to take this spread. There's margin involved, of course. You have to have a margin account. And that's your, and then, like I said, you're only at 40. It's super unlikely you're going to get there, but you're not paying for the spread. So it's basically free insurance, and you will, and then you would make 1.2 million before this hits. And like I said, if that hits, then we can roll it. If we think that, oh, you can, if it hits, you can roll it. You can buy more. You can buy a longer spread. There's so many things that we can do so that we don't get hurt by something like that, which is exactly what we're doing in SQQQ. We sold these longs because they're just too far in the money to ignore. So we've taken the $1 million off the table with a $138,000 profit. And we are converting that into a much cheaper spread that will then cover the rest of the short calls. But it's balance. Again, it goes balance, balance. And when you see your scales tilting too far left or too far right, you know what you have to do. You have to take a rock off the other side. It's very simple. It's not a complicated concept overall, but you just have to get used to thinking about it three-dimensionally. You have to think moves ahead like chess. You have to plan out, well, what if this happens, then what if that happens next, and what if that happens next? And you have to know what you're going to do. So when I say, okay, let's put a stop here at 1350, it was, sorry. Where'd it go? Oh yeah, here. So when I said put a stop at 1350 on TZA, right? Or 13, these calls are at 11.23. So when I said that, and this is what you guys don't realize how much work I put into this. So when I say that, I've already gone to TZA, And I have already calculated where it's likely to go. So in other words, when I said that, it was down here. This is yesterday. This is a daily chart. This is yesterday. It was at 35. And I already said, okay, if it goes here. Now, why is it going to go there? Because the Russell oh, you don't do the Russell anymore? You know, the Russell got weird and you have to pay like for the data, and a lot of people dropped them. Here's the Russell. Okay, so nope, that's not even far enough. I need an hourly chart, I guess. Okay. Oh, I'm sorry. So when we did the STP review, all right. So we were up here yesterday. That's right. So yesterday when I was doing a short-term portfolio review, I think it was like later in the day, we were up here, and I'm like, well, 1750 has to hold. And if 1750 doesn't hold, how much leeway am I willing to give it? And I'm like, oh, okay, it'll go like that. Therefore, if the Russell falls that far, I'll tell you what, the math is a math. It's so if the Russell falls from 1780 to 1700, let's say that's 80 divided by 1780 is 4.4%. That'll cause the Russell to rise 50. That'll cause the TZA. Okay, so actually it's 4.4% times 3, should be exact about this, times 3 is 13.2%. All right, and then TZA, which I have to now go back to here. So TZA was at, I'm sorry, this is yesterday. So TZA was at 37. So now I say 37 times 1.132% is going to be 41.88. So that becomes my stop line. So now I say, if I go over here and I look at TZA and I look at my 30s, was it the 30s? What's an update? Hate that. Now I forgot what ones it was. No, it's short 60s. Sorry, so it's a short 60s. Oh, that's okay. That makes sense. Oh, damn it. So then I go to the 202460s and I say, okay, what's my delta? 57. All right, so my delta is 57, but even easier than that, I can just go to the 55s, right? And I can see what they cost, and they cost $13.50. So, or less than $13.50, but whatever, 13 something. So therefore, I say, okay, well that means if TZA goes up $5, then the 60s will become worth what the 55s are worth, and that's $13.50, and that means that that's my stop. Now, yesterday it was different; it was 13, but the same concept applies. So in other words, when I looked at yesterday, I said, okay, so about $13 should be the stop, because that would mean 1700 is failing, and that's a point at which, because 1750 needs to hold, 1700 starts failing, I've lost faith in the Russell. Therefore, I've got to steer my ship more bullish. So that's how much work it takes for me to write this little sentence here. just so you know why it takes so long. You know, and it's not just that, because that's what I arrive at after looking at like other different, it's like chess again. It's like, well, what if I do that? Or what if I make that move? Or what if I make that move? Well, if I make that move, he might make that move or that move or that move, right? Because every move I make, the market might go up, down, or sideways, right? So I've got to think, if I make that move and the market goes up, what's going to happen? If I make that move, the market goes down, what's going to happen? If I make that move and we're flat, what's going to happen? So you've got to think of all the possibilities of all the things. And then after that, you've got to say, well, if I do that and the market does that, then I'm going to do this. And you have to arrive at the combination that gives you the best chance of success. So it's a shit ton of work. You got to take it really seriously. You can't just arbitrarily pick targets and let it go. But that's how I come up with it. So if you want to know how to hedge, that's how you hedge. You have to understand the mechanism of the hedging. And it's no different than saying, though, how do I fly a plane? Well, you got to know what flaps do, and you got to know what a rudder does, and you got to know what the steering column does when you pull it up and back, if that's what you call it. You got to know what all the pieces do, otherwise you're going to crash, right? You can't just get in and fly the plane. That's not how it works. You have to understand how it operates and understand that if I do this, then that's going to happen. If I give it more gas and this, if I pull back on the wheel and I accelerate, what's going to happen? If I pull back on the wheel and I decelerate, what's going to happen? If I pull back on the wheel and I decelerate and I move and I turn this rudder this way, what's going to happen? Okay, you have to know these things. If you don't know those things, you are not going to be able to handle every situation. If you can't handle every situation, when a situation happens that you can't handle, you will crash. Happens all the time. Happens to Harrison Ford every year, apparently. He's always finds that. It's unfortunate with rich people, like they skirt the rules, like they pay to like skip over things, and that's a stupid thing to do when you're a pilot. It's very tedious, but you've got to put in the time. Anywho, so where was I? All right. So that's the bulk of hedging. You need to pick a position that's going to pay off if the market does X, but then you also have to, at that point, then say, well, what if it doesn't do that? How much is this position going to cost me? How much am I going to make? If you're not making enough in your longs to more than cover the hedges, what are you doing? And that's what it is about this thing. If we go below a certain level in the market, if we can't hold this line, then our cost of hedging starts rising. Now we have to be, now you saw I'm immediately putting in $400,000. That's over 15% of our cash is going to go to steer us more bullish. All right, and like I said, it doesn't change the balance of the portfolio. I'm just moving cash from cash to a negative on the portfolio, removes the negative from the portfolio, removes the cash. Now, it doesn't change the balance of the portfolio, but it then turns us much more bearish in the TZAs. That's a steering thing, right? But still, I then have to look and say at a certain point, you have to be cognizant of the fact that if this thing drops another 20%, our hedges blow up. That means now I've got to take another 400,000 here, 500,000 here, and start buying more hedges. And if the market goes the other way, I'm not going to get it back. So this whole thing becomes really, really expensive, and I'm only doing it so that it was to attain neutrality, because I don't know what's going to happen. So if you don't know what's going to happen, and you have to spend a fortune to maintain neutrality, then what are you doing in the market? Then get out. There's no law that says you have to be in the market all the time. If you're not sure what's going to happen, get out. If times are uncertain, get out. It's like it's like in colonial times, right? So I saw the coolest map on Columbus Day. They had a map of where all the tribes were and so on and so forth. And so America was like filled with Indians. Just everywhere was Indians, except obviously we had pushed them out of the East Coast. But the rest of the country was all Indian nations. It's incredible. I can't even imagine how many of them we killed. I mean, it's just a horrifying thing to think about. We just systematically just wiped them off the planet. It's really, really, really bad. I don't think a couple of casinos makes up for it. But anyway, so the point being that, you're in colonial times and you live in Boston, all right? And you can go down the road to Connecticut and you can go to New York and there's paved roads and so on and so forth. And you go that way. So it's not a problem. You just go. You don't need hedges, right? You don't need guns. There are police, there are lights, there are this and that. You are fine going in this direction or that direction or that direction. You can go to Providence. You can go north to Maine. There's a lot of places you can go that are fine. But you start heading west, and you're into uncharted territories, no people, no people of your kind, no white people. There are no police, there's no one to call, there's no roads, there's no lights along any path. You're just basically blazing a trail through a territory surrounded by people who are probably hostile. And I'm sorry, that's an unfair being all politically correct. It's an unfair characteristic of that. The Indians were hostile because the white people were killing them. They weren't hostile by nature. It wasn't like they were running around trying to kill white people until the white people started killing them. Then they're like, hey guys, cut it out. Like, that's not cool. I mean, just like anybody else, they war over territory and so on and so forth. So people are people in the end. But we're the ones that came in and took their land. Keep that in mind. But anyway, so if you start going west, you are now risking getting killed. So the answer is, so now you say, okay, well, if I'm going to go west, I need to get an expedition. I need to get several men. I need some hired gun people to watch us. Like some good cowboy types to be protecting everybody. And we're going to need a covered wagon because we don't want to be too exposed. We want to keep our stuff all in one place so we can protect it, blah, blah, blah. So now all of a sudden it's getting really, really expensive just to go west. And so a sensible person would be like, well, why are you going there? Don't go there. That'd be like, what's his face, Larry David, right? Just don't go there. What are you doing? Why are you making all this effort to go somewhere? And what are you going to find? It's the same with the portfolio. It's like, why are you holding all these positions? What, obviously, because I hope they go up, right? Which is the same thing as saying, I hope to find gold if I go west. There must be gold somewhere, so I'm going to go west. It's not a good enough reason all the time, right? Just stay where you are until you're sure. Let somebody else blaze the trail. You don't have to be the first guy buying everything. You don't have to be the last guy selling everything. You can go to cash. It's not a mark of shame. And when you're in cash, there are always opportunities like Simon Property. Like right now, if I had cash, I would buy Simon Property. No question about it. And there are other things I would buy Yeti. No question about it. I would buy Yeti. Paramount. I would buy Paramount. I would buy AT&T. There are things that are just so cheap that I can't see not buying them. And maybe if we cut back our portfolio, and this is basically how we end up with the portfolio we have anyway. Every time we cut back, these are the survivors, and then we add new cool stocks. But if you can't adequately hedge them against the possible downturn, against the danger that faces them, then why do you have them? I'll take AT&T. Oh, see, I can save time by just doing that. There you go. I'll take AT&T at freaking $16, not even $16, because it's ridiculous. And if they go to 7, I'm happy to double down. I don't think AT&T is going bankrupt. That seems silly to me, right? And if you look at AT&T, look at this. Where does that come from? Is that always there? See, this is weird on this computer. Anyway, so AT&T, $111 billion. They make, this is so stupid. In 2016, they made $12 billion, okay? Then they made 29 billion, 19 billion, 13 billion. It's up and down. They invest sometimes, they buy stuff. Here they lost $5 billion in 2020. Now, part of the reason, though, is it's not for lack of money. Money was still coming in. It's that this is the year they were bidding and buying all the 5G assets. So they spent $40 billion buying 5G assets. That meant they made net no money. Not only made net no money, but they borrowed money. So their borrowings increased and they made less money. But it's not a loss. It's that they took their profit, or what would have been profit, and they bought something with it, and that then became an asset. All right, well, this doesn't have assets, but they became an asset. Oh, net fixed assets. Yeah, that became an asset that went into their portfolio, so on and so forth, which they then, by the way, depreciate, causing an additional loss. So they buy all this 5G bandwidth, and that's an asset that they then start depreciating. And they put up new 5G towers and so on and so forth, which they then start depreciating as an asset. So their base of assets gets bigger, and they depreciate them more. And tax rules change and so on and so forth. So there's a lot of reasons things happen. But the bottom line is, you know, when you look at the cash flow of the company, where's the actual number? Profit, EPS, net debt, book, average shares, cash, etc. Blah 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 blah. Anyway, when you look at the bottom line company and the cash flow and so on and so forth, they're a money making machine. And $18 billion divided by $111 billion for the company is 111 divided by 18 is 6. There you go, 6. See, it's a PE of 6. So if you give them $10, they're going. I'm sorry, if you give them $6, basically, you give them $6, they're going to give you back $1 each year. So you're making 15% a year on your money with AT&T. Plus, they pay a dividend. On top of that, they pay a dividend. So they earn. So for every 6 you give them, they earn $1. And then they also pay you, is it 88 cents? That doesn't sound right. I can't, it's too much. Who's 88 cents? That's CIM or something, right? Ooh, $1.11. Come on. Come on. Oh, wow. they pay you. And they, I'm sorry, not for $6. That's the difference. It's for, well, for every $18 you give them, let's say it's an $18 share, it doesn't matter. For every $18 you give them, they're going to make $3. That's the ratio. They're going to make $3 and give you another $1. So you can get $4 back on 18 per year. 4 divided by 18, 22% a year. That's how much you're getting back from AT&T. So if it drops 50% to $7.50, what am I going to do? Am I going and they're still making the money, and it's just dropping because all the market's down and the sentiment's down. What am I going to do? I'm going to make my whole fucking portfolio AT&T. Do people still use phones? Yeah, they still use phones. Okay, well, wait. Let me understand this. AT&T still has 200 million customers, right? Yeah. And those 200 million people still have phones, right? Yeah. Did phones go out of fashion? No, people still use phones. Are they making less money? No, they're not making less money. They're making about the same amount. Maybe they're making 20% less because it's a recession. Okay, they're making 20% less. They're only making $14 billion. But now I can buy the company for $50 billion. So of course, I'm going to buy more. I'm not making my decision based on the price of the stock. I'm making my decision based on the value of the stock. What am I getting for my dollar? And when that money is ahead of inflation, we're okay. Now, that is not to say inflation can't go higher. And if the Fed loses control or becomes seen as ineffective, or if we have, like I said, if we have another round of COVID and they have to do stimulus again and they put another 5 trillion, blah, 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 and we have 40 trillion in debt, there is going to come a time when people care about the money we owe. It's really messed up. So, I mean, honestly, with the Fed, I don't understand why they're trying to control inflation. It doesn't really make sense because we need inflation. We need inflation to grow our GDP so that we can afford our debt. Because right now, our debt of $32 trillion is 150% of our GDP. And it's very hard to get your way out of 150% of debt. If you have a $100,000 salary and you have a $100,000 salary, you get taxed $40,000, right? So you got $60,000 left in your salary. And your basic household expenses are in the 40, 50 range. So let's say, you know, and again, you're not living high on the hog here, which is sad when you're making $100,000. But you've got a household, you've got expenses, so on and so forth. So you've got $60,000 left at the end of the day from in your paycheck. You've got 45, 50,000 expenses, let's say 50,000. That leaves you with 10,000 discretionary dollars, and you have 150,000 in debt. And that debt is being charged at even 5%. That's 7,500 in interest, leaving you $2,500 to pay down your $100,000 of debt if you took it all to that. But that means you're saving nothing and just paying down your debt, and it's still going to take you 40 years to pay down your debt. That's 150% in debt. That's what this country is. Except it's worse than that because our expenses are currently 120% of our, 110% of our GDP at least. So we're going 10% further into debt every year and servicing our debt, but the debt is being serviced right now. Here's the key to the whole thing. I said this before, but I mean, you can't repeat it often enough to understand like where the lurking danger is. National debt clock. See, Google knows me. You know what I like, baby. So there's our debt. It's going to be 32 trillion because here's our deficit. So we have a $32 trillion debt, basically. Okay, but look at the interest. I know it's somewhere. Where is the interest, baby? Oh, come on, man. Interest. I know somebody sees it and is probably going crazy. Like, here it is, Phil. Son of a bitch. Debt, state debt, revenue, total debt, personal debt, interest paid, total interest paid, bank interest received. What the frick? Really? They don't have that number? I'm really baffled. Trade deficit, debt held. Stop popping up. Bank interest received. Interest on debt. Ah, there it is. See, I know somebody was sitting there going crazy because I couldn't see it. 448. Okay, so $448, that's billions, right? That's $448 billion divided by $31,153 billion, right? Am I doing that number right? Yes, I am. Is 1.4%. So this number represents 1.5% of this number, not even adding the extra trillion. So what is wrong with this picture? Because interest rates at the Fed are now 3.25%. And do you know what 3.25% is of 32 trillion? That's that many. That's billions, right? So 32,000 billions times 0.325. No, sorry. 0.325. That would have been a shocking number. $1 trillion. All right. So this, still can't find it. This number goes to $1 trillion. That's $500 billion more interest on the debt. That means that this number goes to $1.5 trillion. Because unless you then raise money. So you say, okay, well, wait a minute, that's not good. But so if you want to cover just the interest on the debt, just at 3.5%, don't forget, and the Fed's going for 4.5 or 6. Oh, yeah, let's talk about that. Okay, so here's now again 32,123 times 0.045 is 1.44. That's an extra $1 trillion added to the deficit, okay? An extra trillion. Or at 6%, 32 times 0.06 $2 trillion. See how fun that is? So if the Fed raises rates to 6%, and another thing, this government spending, that's going to go up 10%, isn't it? Because inflation. So that goes up $500 billion. This goes up $500 billion, the interest, and then maybe $1 trillion, $2 trillion. Now we're running a $2-3 trillion deficit, 10% of our GDP almost every year, just like Japan does, because this is exactly what happened in Japan. Inch by inch, you make a policy decision and you put yourself deeper and deeper in a hole. This is how people go bankrupt. It's a series of steps where you think you're going to hopefully figure something out here, and maybe this, and try that, and borrow this, and now if I can just reborrow this money and do that with that money, this is what happens. And then it turns out you can't. And all of a sudden the reality is, no, I owe this much money, and the interest rate is now this much money. And that's just the interest. You're not paying it down at all. So what can you do? Well, you could collect an extra $1 trillion somewhere, right? You could cut this. You can cut this number. Jesus Christ! But but again, that's bad too, right? It's not good for the economy. We were just talking in the beginning about how great it is that they're handing out money to lithium companies and so on and so forth. Great. Or why? Because you're creating you're creating a new economic sector. But the problem is here. This number, if we can't increase this number, and the Fed is fighting hard not to, which I think is crazy. So they're raising the interest. It's a fact. This is going to go up. They're keeping this in check. Not raising the national debt. They're raising our GDP. The spending isn't changing. Congress is still spending, and they want to cut taxes, which is nuts. But the only way you can fix this is to tax another $1 trillion. And how much is federal tax revenue now? It's almost $5 trillion. So you would have to raise taxes 20% in order just to keep the deficit at $1 trillion. You have to raise it 40%. Here's why it doesn't work, right? To cut this deficit without cutting spending, 40% more. But then if rates go up to 6%, it's 60% more taxes have to be collected. And you run those numbers and you say, well, that's not going to happen. I'm a freaking bleeding heart liberal, and I'll get a gun. And I'll get a gun and say, over my dead body, 60% more taxes. But that's the problem, right? It's not viable to do that. Part of the problem is also, though, that we have a country where we have decided that paying taxes is some evil thing that we shouldn't do, and that there's a whole party that promises you can live your life tax-free, which is why we have $32 trillion in debt in the first place. It's not a good thing to encourage. Oh, I'm sorry. There's another point about this. This is a bullshit number. I forgot about that. This is a bullshit number because the income tax revenue, and this makes everything much more horrible. The actual income tax revenue is only $2.6 trillion. It's $1.4 trillion is payroll tax revenue. That's how you get to $4 trillion. So there's tariff revenue. That's still a mess. That's what Trump started. Corporations only pay $398 million. That is horrifying. So they only pay. So remember this number was like 1.2%. That's the same as corporate taxes. It's like 1.2% of GDP is paid by the corporations, and that's it. And we're paying this. We're paying 4, which is 15% of the GDP. Is what people pay. So we pay 15, they pay 1.2. So people pay 10 times more taxes than corporations. And believe me, they make more money than people do. Because don't forget, all these guys who are multi-billionaires, right? They only own a percentage of their companies. So whatever money Jeff Bezos has, whatever money Bill Gates has, whatever money these other guys have, it's only a percentage of what their company has. Yet their company pays no taxes. How's that for insane? So that's one place you could get money, is by actually charging corporations a proper rate of taxes. But like I was saying, so the problem is This is your payroll tax revenue. This shouldn't be included. This should not be included in federal tax revenue. It shouldn't be touched. It should be sacrosanct. It should be completely unavailable to the government. You can't just lump it in with the money. And if you did do that properly and you kept it aside for Social Security, then we'd be running a $2.5 trillion deficit, because this isn't their money. It doesn't count. Really messed up. Anyway, so that is the reason why you have to always be thinking about the concept of cashing out, because this is a big, big problem. And it only takes somebody pulling the covers off on this and exposing it and saying, come on, there's no way. You can't fix this. You will only just go further. You're going to only go further and further into debt. You either have to cut government services to the bone, which Japan has done. We talked about that the other day. Japan has cut their government to nothing. They don't have any money for it. Their government is a quarter of the collections. A third of the collections go to paying their interest on their debt, which is staggering because they're only paying the same, like they pay less than we do. They pay less than 1.2% interest, and they're still paying a third of what everything they collect goes to that. Because they're 300% of their GDP in debt. So if it's not us, it's going to be Japan or it's going to be China. There's going to be massive defaults because if these interest rates keep rising and rising, it's going to hit a breaking point. And you know, I thought the plan would be to inflate our way out of it. So in other words, if you allow inflation and you have 10% inflation for 5 years, we'll have a $60 trillion economy. Now, if you could do that while not completely blowing up the deficit, then we would shrink the debt to GDP ratio from 150% to maybe 75% or something like that. That would be huge. Maybe even if it was 100%, it would be a huge improvement. Even if we have a $60 trillion economy, the GDP is 25 trillion right now. So if we get the GDP up to 60 to 50 trillion, even if this goes to 45, it's a huge improvement. I'm talking about in like 5 years. So if you let 10% GDP growth, just like China has for many years, they grew their GDP faster than their debt, cuts them out of trouble. The second their GDP slows, though, they're not slowing their spending. They can't. COVID happened, put them massively into debt. All of their surpluses are gone. They're on a debt cycle now. And also, their whole economy was based on the government constantly funding projects that didn't even make sense, like hundreds of airports they don't need, hundreds of train lines they don't need, whole cities that they don't need. That, in theory, adds to the GDP. You can build a city and it adds construction and so on and so forth, jobs and all that. But if you then leave it and it's empty, what did you do? You spent $1 trillion on a dead asset. That's going to come back and bite you. So at some point, somebody's going to fail. Somebody big is going to fail. And it's most likely going to be Japan. And it's second likely going to be China. Third is Russia. Russia's only third. They're actually in better shape than China and Japan. But people are going to fail, and the borrowers are going to be in a 10% interest environment. This is what the Fed's scared of also. In a 10% interest environment, people demand. That's what I was talking about when you're lending the banks money. They don't want you to think like that, but you're lending your money. You're choosing to loan your money to the bank, and they're giving you nothing for it. But when they loan money out, they want their 6%. And that's bullshit. And we come to accept that as being okay. But that's a tax on you. That's a tax on your income. You want to borrow money, it's 6%. You want to loan money, it's 1%. That is incorrect. And like I said, with modern systems, there's no reason for these banks. All they do is suck 5% of your income out of you every year. And they provide no actual service. It's not necessary. They don't, the guards and everything don't matter. The computer could be anywhere. There's nothing very special that they do. I mean, frankly, there's like a, you know, a whole host of companies like PayPal takes better care of your information than these banks do. You know, yeah, it's the federal regulation and the loan and the FDIC that makes the bank worthwhile. But if not for that, if you had and that's why I like SoFi. If you have SoFi and they got their banking license, if you have SoFi and they've got the same FDIC and they've got the same everything else, what do you need these banks for? And then SoFi one day can turn around and say, hey, we're going to give you 3%. We don't have to give you 1%. We'll give you 3% for your money. We appreciate the fact that you're lending us money. And you never hear that from the bank. You're depositing your money. It's a mind game. It's double think. What's it called? Double think. Newspeak and double think. Yeah, that's right. From 1984. Just you get people to talk a certain way and use certain phrases, and they don't think about it the same way anymore. But when you deposit money in a bank, they're taking your money and making money with it, and they're not paying you the value of your money. No way, shape, or form are they doing that. And that's what makes them rich and you poor, basically. And especially, don't even get me started on poor people. Anyway, all right. So that's that. What else do people say to me? Oh, somebody says not responding again, the site? No, don't even tell me that. That made me very sad. All right, anyhow, so if next time we'll talk more about positions and portfolios. We kind of got sidetracked on it this time, but I think hopefully that was helpful. And we will do it. Oh, I'm sorry, we're not going to. Oh, wait. Why is this taking so long? It's driving me insane. Oh, because WebAir. Yeah, I forgot already. So it's a service provider that has a problem, I guess. Ugh, killing me. Error establishing data. Yep. Damn it. All right, guys. Sorry about that. But anyway, so no. Oh, you know what? I didn't even realize it's 4 o'clock now. No wonder I've been going for so long. I was wondering where my voice is going. All right. So at least we have the webinar. We're not doing one next week. I'm going to be traveling. I've got a wedding up in Massachusetts. I'm doing a bunch of business calls while I'm up there. So Wednesday's the day I'm coming back, I think. So we will see what happens. T got WBD, thanks. Oh, okay. All right. Anyway, guys, thank you so much for coming. We'll do it again not next week, but the week after. Okay, take care. And happy Halloween.